Let's take a look at your market news now. Asian market performances were mixed, but mostly down. This as investors trod water ahead of US inflation data. Now, there's a concern that if the print is high, it could lead to US 10-year Treasuries pushing even higher after reaching 3.1%, a signifier that borrowing costs are likely to go up. Players were also set to keep a close eye on those second-round US-China trade talks, which start today in Washington. Tokyo stocks had a good run. The Nikkei share average rose 0.5%. Hong Kong was among the lackluster performers today, with the Hang Seng Index not doing so well. It was down 0.4%. Sentiment in China was also downbeat. The Shanghai Composite Index declining by 0.5%. Wall Street stocks were higher on Wednesday, with retail and technology stocks leading the charge. This despite US bond yields touching near 7-year highs, while investors also continued to fret over geopolitical issues. The Dow Jones Industrial Average rose 0.25%. The S&P 500 gained 0.41%, while the Nasdaq Composite Index added 0.63%. For more on the markets, we cross to the Johannesburg Stock Exchange. Nompumelelo Siziba is standing by. Good afternoon, Nompumelelo. We're seeing oil prices hitting just over 3-year highs and breaching the $80 per barrel mark.
That's right, Nzinga. It's crazy. It's breached 80. It's come back down. It's around 79.92. So I bet you it's going to hit through 80 again. So it's obviously negative because on top of that, we do have a slightly weaker rand vis-a-vis the US dollar and other currencies, in fact. So that means a double whammy, and it means that we're going to feel it more at the pumps going forward. I think AA has already put out a caution that we should expect something north of 70 cents a litre for the next round of increases. So not good at all. What we're also seeing globally is that people are looking out for that US inflation number. There's a concern that it will be a high number, and if it is, there's a concern that those US Treasuries are going to move on higher, which will mean higher interest rates and higher borrowing costs. And of course, it will be negative for emerging markets because people will decide to take their money into US Treasuries and take them out of perhaps our equities and even our bonds, even though we still offer quite good returns. As I mentioned, the rand hovering around 12.50 against the greenback. Let's take a look at the indicators. Well, he went to visit his land, but he's since come back from Scotland. Chris Gilmore, our independent analyst, has joined us. Welcome back, sir.
Thank you very much, Nompu.
Good stuff. So everyone is bracing themselves for this rude US inflation number. Will it be rude? Will it not? If it's high, obviously, it's going to have all the effects that I mentioned. So how are global markets responding now? It seems as though they're pretty much all somber.
Yeah. Look, I think global markets have largely anticipated another at least three interest rate rises during the course of this year, some even 4. If we get a much higher inflation figure than has been anticipated, then that might throw that out. In other words, you could be looking at more than that. Because obviously it is the remit of the US Fed, the Federal Reserve, to try and keep inflation under control by way of raising interest rates. So given, and you put your finger on it in the preamble there, if investors perceive a better return, relatively risk-free, in fact risk-free, as risk-free as you can get, in US Treasuries, then the likelihood is they're going to move out of equities and into bonds. And as Nzinga was saying earlier, the US bond rate the yield on US bonds has been rising overnight again. So I think the likelihood is that if we see this higher than anticipated inflation rate, it's going to be negative for global markets.
For emerging markets, what does it mean?
Yeah, for emerging markets particularly, if you go back to 2007, 2008, emerging markets were actually looking quite good. Yes, they had a bit of a thump, but they came back because their fundamentals were good, their balance sheets were good. That's not the case now. So if you look at countries like Argentina, for example, you look at Turkey, you look at many of these large emerging economies, their intrinsics aren't nearly as good as they were a few years ago. So I think if we see a shakeout in global markets generally, I think it's going to hit emerging markets proportionately worse than would have been the case a few years ago.
That oil price, very scary, weaker rand, combination, what does it mean?
Do you know, if we look at the oil price in isolation, first of all, in US dollars, I think it's predominantly there because of geopolitical tensions, notably in the Middle East, and specifically with reference to Iran. And Donald Trump, in his infinite wisdom, you can see the sarcasm dripping out of my mouth here, deciding to reimpose sanctions on Iran. Interestingly enough, you know, we don't have the degree of solidarity in the international community in terms of sanctions that you had a few years ago. A lot of the European countries, for example, don't want to do it, but nevertheless, it was enough to put jitters into the oil market. If you look at what's happening in the US, now the US is still a very, very big producer of oil, and to get an indication of potential new finds there, you have to look at what's called the rig count. There's a company called Baker Hughes, and they go out every week and every month and pretty much every day counting the number of rigs in the US. Currently around about 850, and that's up from about 500 and something a year or so ago. So what I'm saying is, in the US particularly, the higher oil price is attracting in a lot of new prospectors there. Not just an existing traditional oil wells in the US, but it's getting the shale oil producers to come back as well. So that, I think, will provide a bit of a cap to the oil price. So I don't think we're going to go back to the kind of figures we had back in 2014 of $115, $120 a barrel. We could stay at these kind of elevated levels for a while yet. But to answer your question, if the rand stays where it is, all other things being equal, yes, we're going to pay more at the pumps next month. If the rand weakens, going back to what we're talking about, if emerging economies generally fall out of favor, then you can get this really nasty pincer movement, this double whammy, and a very negative double whammy where you get a weak currency and a higher US dollar oil price, resulting in a significantly higher petrol price at the pumps.
Not good at all. And then, of course, here at home, we do see that everything is down. Is there any particular reason, or is it just pretty much in line with global markets?
I think pretty much in line with global markets. I think our market does need to have a significantly weaker rand to make it actually go anywhere at this point in time. If you look at the composition of the all-share index, I mean, the top 10 account for something like, what, 65, 70% of the total market capitalization of the market itself. So, I mean, take yesterday as a good example. 10 cent and had a nice set of results. So you see Naspers moving up very, very significantly, and Naspers accounts for a huge chunk of our market because of its rand hedge qualities predominantly. So you know, if the rand stays where it is, if nothing untoward happens on global markets, if we don't get that much of a shakeout, I think we're pretty much going to get sideways. If we get a bit of a shakeout taking place, then I think strangely enough, the market could be a bit of a haven, because we will get, what I've said before, with a likelihood we'll get a weaker rand, and that will help to bolster the markets in the event of it taking a bit of a tumble on global markets.
And then today we have that US-China trade discussion happening in Washington. What can we expect?
I think there's been an awful lot of bluff and bluster with this one on both sides, but particularly on the US side. Trump is nothing if not a negotiator. That's his whole raison d'etre. When he was in business, when he in his position as leader of the so-called free world, you know, Donald Trump goes in there and he throws an awful lot of nonsense that he expects his adversary to kind of pick away at. And I think that's really what's happened. I think we will get a far better deal between the Chinese and the Americans on trade than we hitherto thought was the case, because there's an awful lot of nonsense to pick away at the edges. So I'm actually quite optimistic. We're certainly not going to have trade wars breaking out, and I think we could be pleasantly surprised on the upside.
I'm going to save your words and replay them to you in 2 months. Thank you so much, Chris. That was Chris Gilmore. He's an independent analyst. After a short break, in Zinga with more business news for you.